This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
This week's Fed cut was all the rage, but had been so telegraphed the market reaction was muted. Up next, Fed policy certainly always matters, but maybe a little less than you think, and you'd be better served focusing on earnings, valuations, and yes, falling yields on cash. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Pardon my voice, I'm getting over a cold. I always have a bit of a nasally accent, given my Baltimore background, but a little more nasally than normal, so apologize in advance. A lot going on this week. Obviously, we got the first Fed rate cut in quite some time. I'll talk about that. But before I get into it, do want to continue to harp on this idea that I've been harping on for a number of weeks, if not months, that what goes up doesn't necessarily have to come down. I know there's this sense of foreboding that the market rebounded so much coming out of those April lows that we're due for a big downturn. Well, I've continued to push back on that just given the historical precedent. Now, that does not mean that we can't have a pause. It doesn't mean that we can't have a correction at any time for any reason. But it does mean that the longer-term outlook, given this kind of surge off the bottom, is probably pretty good, again, based on history. Everyone talks about weakness in September. I've talked about weakness in September, how it's traditionally the worst month of the year for the market. But when that weakness fails, like it has so far this month, meaning this month has been better than people thought, it's actually been a bullish signal, believe it or not. According to FactSet, if you go back about 50 years, when you've had a negative September, Q4, fourth quarter returns for the S&P are generally 1.3% on average. When you've had a positive September, like we're on track for, obviously it could change in the next week, but that's what we're on track for, Q4 S&P 500 returns average closer to 4.5%. I read something from Carson Group's Ryan Dietrich. He's a trader I've been following for a long time. He mentioned this week how he just completed one of the best 5-month rallies ever, up more than 30% in the last 5 months. And he mentions how since 1950, this has only happened 5 other times. Well, guess what the historical precedent says? A year out from that, the market's been up 100% of the time. On average, 18%. Okay? So again, what goes up does not necessarily have to come down, at least over any reasonable amount of time. Same thing if you look at the Dow. The Dow closed above 46,000 the other day. It hit 45,000, think about 9 months ago. The past few times where we went 6 months without a new 1,000-point milestone and then made one, it made multiple new 1,000-point milestones in a row. Point is, momentum breeds momentum. There's that famous quote from Jesse Livermore. He's one of the most famous traders of all time. A body in motion tends to stay in motion until a force or obstacle stops or changes that motion. Okay? So, again, am I saying that we won't have a correction? Am I saying that you should throw caution to the wind? Of course not. But assuming that every dip or scary headline is that force that will stop the trend, is probably not the way that you want to be proceeding right now. All right, enough on that. So like I said, big news this week was the first Fed rate cut in some time. It had been largely telegraphed. If you recall that old market truism, the Fed tells the market when it's going to raise rates. Market tells the Fed when it's going to cut rates. The market had been pricing in several rate cuts for some time. You look at the 2-year Treasury yield, which is a really good referendum on where the market thinks the Fed will be. That has been coming down on a line over the course of the last few weeks. And I'm not going to get into all the machinations of the Fed, but essentially they cut rates by a quarter point and kind of signaled, although they did say it will be data dependent, so they didn't commit to this, but they signaled that we get another 2 cuts later this year. And then if you look at their kind of dot plot graph for the next couple years, that we probably drift down to around the 3% range on the federal funds rate from what was 4.25% earlier this week. Okay, so roughly somewhere between 100 and 125 basis points of easing is expected over the next year and a half or so, give or take. Okay, so that's kind of what's going on. I think kind of what's interesting is, since 2009, the Fed has done exactly what the market was expecting it to do in every single FOMC meeting. If the market was pricing in a hike, they hiked. If the market was pricing in a cut, they cut. So this was not a big surprise. Like I said, this was largely baked into the cake, which explains why I don't think you got a big dramatic move in the market one way or another, late this week. I think the other thing that's kind of interesting is, though, that remember, just a couple months ago, in June, the federal funds rate, if you look at the futures on the federal funds rate, I should say, was predicting that it would be around 3.6% by the end of next year, not the current 3% as of this week. So things can change, is what I'm saying. So take all of this with a great deal of grain of salt, in the sense that, any data points, whether it be inflation, job numbers, can certainly change the outlook. But based on what we know today, the market's pricing in short-term rates. Remember, the Fed doesn't control long-term rates. Short-term rates to come in 1 to 1.25%. Okay? Remember, the Fed kind of has this, I won't call it an official mandate, right? But they had this guidance, essentially, that they have to properly balance inflation and the labor markets, right? When they feel that one is getting a little weaker or disproportionately weaker, that's often been a trigger for them to do something. So they obviously felt this time around, and here's Jerome Powell's quote, "Labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant," end quote. Okay, so clearly they feel that the unemployment situation has gotten worse, which I'll get to in a second. What I find interesting is, when was the last time the Fed cut interest rates with inflation this high? Well, I got an answer for you. According to FactSet, it was October of 2008, in the midst of the worst recession/bear market since the Great Depression. Obviously, we're in a much different environment today, right? Unemployment rate's 4.3%, well below the historical average. S&P is close to an all-time high. So this is very unusual, and I noted it from kind of a market perspective, too. Strategists said that this is the first time in modern central banking history where the FOMC has cut rates with banks at all-time highs. It's almost never happened. It's very rare. So this is a different type of rate cut. This is not at least the market is telling us, this is not a rate cut with, recession right around the corner. We'll see. I do think if you look at the data, the economic data, the Fed is pretty well justified in cutting rates at this point, right? I mean, for the first time in over 4 years, there are more unemployed people in the U.S. than there are job openings. The number of jobs in the U.S. has increased by less than 1% in the past year. That's the slowest growth rate since March of 2021 during COVID. After a number of downward revisions, U.S. payrolls have increased by just 27,000 a month over the past 4 months. So essentially, no job creation in this country over the past 4 months. So that's what the Fed is pointing to. And again, the referendum from the market, back out this week's reaction, but just the strength over the past few weeks leads you to believe that the market's taken a positive spin on this, right? I think the market is saying, if prices on goods are going up to some degree, if companies have pricing power, yet the Fed is able to prevent mass layoffs by cutting rates, not only, consumers are going to be able to keep pace with inflation. Consumers are still going to be able to pay those higher prices, which, of course, is great for corporate profit margins, right? Companies don't have to cut prices. Translates to earnings growth and therefore higher stock prices. That's been the narrative, right? So you might ask me, well, Simon, what does history say? What is the precedent for the market reaction to Fed cuts? Well, I'll give you a muddled answer, and it depends. Larry Adams here at Raymond James, he said this week, since 1980, there have been 4 instances where the Fed cuts rates after a 6-month pause, okay, which is, of course, what we're dealing with this time. Well, what it signaled depended on the backdrop. In recessionary periods, according to Adams, the S&P fell 14% over the next 6 months, while in non-recessionary environments, it rose an average of 8%. So, as Adams notes, there's certainly reasons for caution, but he doesn't believe, and this is his words, he doesn't believe a recession is imminent. So these cuts should be taken more as a positive than a negative. A couple other ways of looking at this. Chart Kid Matt, who's a blogger that I followed for a long time, he looked at the average S&P path after a Fed cut going back to 1950. But what he did is he broke out and found that it was about the same. I think it was somewhere around 9% on average over the next 12 months. But he broke it out by where that return came from. And what he was saying is that 6.1% of that came from multiple expansion, 2.9% from earnings growth. So that would be kind of, interesting to say the least, if not a tall order this time around, right? Because we're already dealing with valuations close to all-time highs. So to get valuation expansion, multiple expansion from this point would really be something. The last thing I'll say on this, I don't want to belabor the point. Brian Belsky, he's over at BMO. I followed him for a long time. He identified 10 Fed cut cycles going back to 1982. And what he found is the S&P delivered positive returns in the 12 months following rate cuts for 8 out of those 10 cycles. Okay, with an average gain of a little over 10%. So the reason these numbers are different, by the way, these folks that I'm quoting are all using slightly different starting points. But he found that 8 out of 10 were positive, and it was the macro context that really informed the differences. So in cycles where rate cuts were able to prolong an economic expansion and keep corporate earnings on an uptrend, stocks performed quite well. However, in cycles where monetary stimulus were unable to prevent a downturn, like 2001 and 2007, stocks recorded losses in the next year. So I think you kind of get the point I'm making. You can't look at rate cuts, Fed policy in isolation, right? They're just part of the overall narrative. And the overall narrative includes the trajectory for earnings, the trajectory for profit margins, the dollar. I mean, there's a lot of things that we could talk about. Okay, so that's why I said at the very opening, Fed policy always matters, but you have to contextualize it and not just look at it as a single variable, okay? By the way, there are some contrarian thinkers here out there, I should say, on the positive effect of earnings in this particular environment. JP Morgan came out this week, and I think they made some really good points about how, on the income side, as of the end of last year, American households had roughly 125 million in assets, 14 trillion of which were held in cash, essentially. Money market funds, CDs, short-term investments. So they made, I think, a pretty good point that a sustained decline of 1% in short-term interest rates would reduce annual household income by about $140 million. Okay? And then they looked at it on the liability side. Households owed about $19.5 trillion as of the end of last year, but almost $13.5 trillion of that were mortgages, roughly 90% of which were fixed-rate mortgages. They would not benefit from rate reduction, nor would households likely benefit from a big refinancing wave because the majority of today's outstanding mortgages were issued since the great financial crisis. We're at lower mortgage rates than where they are today, right? So both on the income side and the liability side, JP Morgan's saying, hey, listen, lower rates may not mean a whole lot. And then you could also look at consumer debt. And they argue that only about $1.3 trillion of the current $5 trillion that consumers owe on credit cards, auto loans, student loans, only about, a quarter roughly, is revolving, meaning sensitive to the Fed cutting rates. So essentially they're saying that this is a much less rate-sensitive environment, rate-sensitive economy, rate-sensitive consumer than maybe what we've seen. And so some of these historical analogs may not be as valid. We'll see. I still believe on balance that lower rates are a good thing, but I think, again, it's very important to understand that they're not going to be some panacea that's going to make everything great for the next couple of years. So we have to follow through on a lot of the other themes that we've been talking about, improving margins, resilient consumer spending, those types of things, right? From a market perspective, I think it's interesting that cyclical stocks more levered to the economy, just hit a relative high versus defensive stocks. This is just within the last week and a half or so, okay? So the market is still believing that, the arrow is pointing up in terms of economic activity, and you can see it at the consumer level. It's now been 39 months in a row that wage growth has outpaced price growth. So just in the last month, headline CPI, according to FactSet, ticked up to 2.9% in August, but wage growth was 3.9%. So real wages are growing 1%, 1% over inflation. That has been very supportive of spending in this economy. And as I noted a couple weeks ago, I'm not going to get too much into this, our friends at Strategas really believe that there's some pretty significant stimulus coming next year for the consumer by the way of the new tax bill, right? SALT relief, enhancements to the child tax credit, standard deduction. They think that those will be material to say the least, not to mention you have the World Cup coming, deregulation. So those on top of lower interest rates probably provides pretty good cushion for consumer spending. The other thing I just wanted to mention, and I'm not going to get too much into this because I spent a lot of time on earnings and valuations 2 weeks ago, but just remember, I don't know how many times I've said this. It's got to be hundreds of times. The stock market is not the economy, and the economy is not the stock market. People love to draw a straight line from what the Fed is saying about inflation or unemployment or what the Fed's doing and think that that translates to the bottom line. I mean, some of it is just based on the makeup of the economy versus the makeup of the S&P 500. So according to Bloomberg, S&P 500 earnings are almost evenly split between goods and services, all right? That's a stark difference from GDP. GDP is about 72% services, 16% goods, 11% government. Totally different. So to think that whatever happens in the economy happens on Wall Street, not necessarily. And you've got a lot of other factors too. We know about the weakening dollar. I don't know if you've traveled overseas recently, but if you've been to Europe, if you've been to the UK, you know that the dollar has been very weak against those currencies. Well, weak against those currencies makes it pretty darn good for multinational companies looking to translate those foreign sales back to a weaker dollar, right? No accident that going back almost 50 years, according to Strategas, the S&P has almost 3 times the performance when the dollar is falling versus the dollar rising. A lot of it is that phenomenon of where those revenues are coming from. That's another reason why large stocks have done better than small stocks. They have more of that international exposure. We also know that corporate profits continue to be very strong. Remember, we've seen more job loss with some of these restatements than I think people really anticipated, right? Or even were thinking were the case. So if you have double-digit earnings growth like we've had, with actually fewer U.S. workers than what we originally thought, well, that's consistent with productivity improving, okay, which feeds through, of course, into margins, right? Again, not going to spend much on valuation, but we just have to be careful, folks. I mean, we've talked a lot about the extreme concentration in the S&P of the Mag 7 and tech stocks in general. And yes, people have argued, including me, that the market does look more reasonable if you look outside of those names. But still, according to Strategas, if you look at the market cap weighted S&P price to earnings ratio, in other words, not weighted for size, but just all 500 names having an equal weighting, it's about 23 times earnings. Okay? And if you look at the median price to earnings ratio, it's about 19 times. Well, the all-time high for the median price to earnings ratio was the peak of the dot-com bubble in March of 2000. Okay, that was about 21 times. So we're not far off, even for the average stock in the S&P. Forget about the NVIDIAs and the Teslas, just the average stock in the S&P. We're not far off some of the highest valuation levels. And that just means, again, does it mean you need to go and run for the hills? I don't think so. It just means we have very small margin for error. So make sure you don't have a portfolio where you need short-term returns to be successful. Make sure you have some cash. Make sure you have some wiggle room in your portfolio to do what you need to do to support your retirement, planned expenditures, what have you. But related to valuation, I do want to make one point, and I take historical comparisons with a grain of salt because I do think it's important to note, and I've noted this before, that the makeup of the S&P is so much different than it used to be. So, for example, if you look at what's called the CAPE ratio, cyclically adjusted PE ratio, it's a measure of valuation that kind of smooths out peaks and troughs in the economic cycle, so a lot of people pay attention to it. Well, if you look at the 150-year average, it's about 17 and a half times. That's where the market trades. Currently, we're about 37 times. Okay, so by the historical average, we are off the charts in terms of valuation. But the average of the last 30 years is 28 times. So we're still expensive relative to that, but I wouldn't say off the charts. We're rich, but not uber rich. I would argue that the last 30 years makes a lot more sense to analyze than the past 150. By the way, that data was from FactSet. And I say that because if you look at the S&P, I mean, even as recently as 20, 30, 40 years ago, I mean, I began my career in 1992. Even then, the S&P looked a lot different, right? The S&P was dominated not by the NVIDIAs of the world and the Teslas of the world. It was dominated by capital-intensive industrials. I mean, for much of our history, railroads, chemical companies. These are relatively low-margin businesses that require a large number of employees, lots of physical plant, right? Lots of hard assets, railroad ties, rail cars, big, oil refineries. These are all businesses that many would argue would command a lower multiple because of those drags. Today's leaders, again, look at Microsoft, look at Google, look at NVIDIA. These are companies with way more intangible assets, and they're far more efficient. Again, going back to FactSet, look at margins on a decade-by-decade basis. 1990s, average margin 5.6%. 2000s, 6.3%. 2010s, 8.8%. 2020s, 10.3%. Today, 11.3%. So the margin for the S&P in aggregate is what I should say. S&P margin in aggregate is double what it was in the 1990s. So I'm not going to sit here and tell you that the market's cheap, but I am going to tell you that higher valuations can certainly be justified if you look at it from a profit productivity perspective. That's why I spend a lot more time, and we at the group spend a lot more time looking at those types of things than opining about what the Fed may or may not do next week. I think that's kind of where I'm going with all this. By the way, just a little sidebar to this. It's interesting to note that the great financial crisis, the 2008 crash, started at relatively muted valuation levels. We were about 15 times earnings at that point. So it wasn't high multiples that, led to that crash. It was the fact that no one saw earnings were about to fall off a cliff. And that's the big thing. Multiples can stay longer and elevated for longer than you might think as long as the earnings trajectory is sound. So again, that's why we're focusing on margins, earnings, those types of things, more so than on economic policy. All right, I'm going to take a quick break. I'm not going to get too much into individual stocks today. We're in kind of a dead period where we've heard most of the second quarter earnings, but I do want to talk a little bit about the bond market. I think that's very appropriate given this first Fed cut in over 6 months. Back in a second.
Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As mentioned, I'm not going to get into any individual stocks today, and therefore not going to provide any disclaimers because I'm not talking about any individual ideas. But I do think it's very worth talking about the impact of the Fed on the bond market, and maybe even more relevant to just about everybody listening, cash levels, right? We've all gotten spoiled with being able to get, give or take, if you're in a money market fund, probably somewhere around 4%, right, over the past few months. Some people might get slightly better than that, maybe some people slightly worse, but if you're in a high-yield savings account or a money market account, you've probably been able to get something close to that somewhere at a banking institution or a brokerage firm or a credit union, right? Well, even before the Fed cut rates, if you're in the top bracket, 37% federal bracket, then you add in, state or, other things, right? You're probably reducing that 4.25%, whatever you were getting, down to about 2.5%. Well, inflation's still running close to 3%, right? So your real rate of return, yield relative to inflation, was already negative if you were in the max tax bracket coming into this week. Well, it's going to get a lot more negative, right? Because not only has there been some upward pressure on inflation, and the hope is we don't have huge inflation levels, but let's say inflation hangs out in this 3 to 3.25%, 3.5% range, and let's say what I said earlier does come to pass, that the Fed ultimately lowers rates 1.25% to 1.25% over the next year and a half or so. All right? That means you are going to be underperforming inflation by a lot. So I'm not saying don't have cash. That's obviously ridiculous. We have clients that have cash for a lot of reasons, whether it's to fund retirement, fund a planned expenditure like a tuition payment or a purchase or a remodel. Some people like to have a certain amount of cash so they can basically sleep at night. I totally get that. But I also think a lot of folks have cash just because of inertia. There actually isn't a good reason to have as much cash as they have, right? We encounter plenty of clients who have, $500,000 in cash, and when you do the financial plan and ask the right questions, maybe 150, 200 is the right level. Well, when rates were at 4%, 4.25%, 4.5%, you're like, I'll just leave the other 300 where it is. But those rates start coming down. I really think you need to reassess your cash position, make sure it's the right thing for you. I also think it's worth talking about bonds a bit at this juncture, right? Now, yields are not as good as they were a month ago because yields have come down some on expectation of these Fed rate cuts. But remember, I said it earlier in the show, I'll say it again. The Fed only controls short-term rates, right? Longer-term rates, the 10-year Treasury, the 30-year Treasury, those are the yields that tend to affect or at least inform mortgage rates and other types of long-term borrowing rates. Those are market-driven. Those are driven by expectations about the economy, driven by expectations about inflation. Okay, so it's going to be very interesting to see what happens here the next few weeks. But just to give you a little bit of a backdrop, remember, we are just now, I think we're coming out of the worst bond market in U.S. history. And that's not hyperbole. You go back 150 years, this has been the worst. Coming into July, so as of the end of June, according to the folks up at Ritzold Asset Management, it was the only decade so far where the 10-year Treasury has had a negative return, and only the second time long-term Treasuries have had a negative return. Okay, but in terms of duration, it's been the worst as well. And then if you add in inflation, it's even an uglier picture. Real returns are far and away the worst. But you should also know this. I've talked a lot, and we, probably multiple times over the years about this, proverbial 60-40 portfolio, 60% stocks, 40% bonds. A lot of people declared that kind of an archaic, if that's the right word, strategy because, the bonds weren't doing their part, right? We've been in a situation where bonds have lost money, so the 40% in bonds have done nothing but offset your gains in stocks. But I would make the argument that maybe conditions will be a little different than going forward. No guarantees. I don't know the future any better than you. But if you look at it from a historical perspective, if you go all the way back to 1925, according to NDR, that's Ned Davis Research, a portfolio of 60% stocks, 40% bonds has averaged 8.6% a year. 8.6%. The reason I bring that up is not only is that pretty good return, but the maximum drawdown for a 60-40 portfolio in any one year was 28%. Maximum rise, 36%. Well, compare that to a 100% stock portfolio. Stocks have averaged almost exactly 10, about 10.3% over the same period of time. So to get, 10.3%, versus 8.6%, though, you had to take on a heck of a lot more volatility. I'm not going to get into Sharpe ratios and standard deviation today, but trust me, much more volatile ride. And yes, you had a 55% upside potential. That was the best, but you also had 43% downside potential. So by only giving up 1.7% a year, on average, going back to 1925, which I don't think is a dramatic amount, you've had not only a much smoother ride, but you have fared much better during the major crashes. As I mentioned, the last few years has been the worst in 150 years. Just to put that in perspective, there was a study in Morningstar where they compared what they called it sort of a pain index. So not only the maximum depth of a 60-40 portfolio, but also the maximum duration of a poor performing period for a 60-40 portfolio compared to the Great Depression, which was the worst of all time for stocks and bonds. And long story short, I won't belabor it, they said that the Great Depression was 4 times more painful for the stock market than for a 60-40 portfolio. The lost decade, 1999 through 2009, was 7 times as painful for the stock market as it was for a 60-40 portfolio. And the COVID-driven stock market crash barely even registered for a 60-40 portfolio. So I only say all this as to indicate that what we've seen in the last few years was a once in 150-year event. Most of the time, a 60-40 portfolio has been a good thing. And remember what I've said before, there's a high correlation between starting yields and future returns, meaning if the 10-year Treasury is currently yielding a little over 4%, then I think it's 4.15 as of this writing. There's about 90% correlation between that and future 7 to 10-year returns for bonds. So that's why Vanguard has come out recently and said, well, we expect U.S. aggregate bonds to return somewhere between 4 and 5% a year over the next decade. U.S. equities, somewhere between 3.3 and 5.3. So they actually came out and said your allocation, the optimal allocation, should be 70% bonds, 30% stocks. Much more conservative than what I'm talking about. So am I saying they're right? I have no idea. Am I saying get out of the stock market? Of course not. We own a lot of stocks for our clients. I own a lot of stocks personally. I'm just saying that with the Fed cutting short rates, with cash yields coming down, this may be a time to start exploring the bond market in a little bit more depth and seriousness if you have not been exposed there so far. Okay. I will just say a couple words about municipal bonds, tax-free bonds specifically, because I think they're particularly interesting. When you look at the yield curve, in other words, the spread between short-term yields and long-term yields, municipal bonds have far and away the steepest yield curve, meaning you're getting much more yield if you go out 20 years than if you go out 2 years. That's somewhat of the case with corporates and somewhat of the case with treasuries, but much less so than you see with municipals, okay? As of about 2 weeks ago, it's changed a little bit recently, but as of about 2 weeks ago, according to Morningstar, long-term municipal yields, this is their words, I don't know exactly what long-term means, but long-term municipal yields were getting 0.91% of what treasuries were yielding. 0.91. Well, treasuries are state tax-free, but municipals are federal tax-free. So you're getting darn near the same yield on a long-term municipal as you are a long-term treasury, despite the fact that your income is going to be federal tax-free. That's a huge difference. Huge difference. And by the way, it's gotten even more the case over the course of this year. So if you compare municipal yields today versus January, short-term yields have actually come down. So short-term munis in many ways, 2, 3, 4 years are actually not that competitive, versus treasuries, CDs, and other things. But long-term municipals have gotten much more competitive versus treasuries. So this has been an evolution just in the last 7, 8 months. So I'll just give you a couple examples, and let me be very clear. These are for illustration purposes only. I doubt you can get these yields today because this was as of a few days ago. The market's changed, so don't think that these are recommendations. I'm not treating them as such. I don't own these bonds personally, nor do I own them in our client portfolios here. But I just wanted to give you a couple examples. So Fairfax County Sewer Authority, which is a revenue bond, AAA rated by Moody's and Standard & Poor's. They have a bond that pays a 4% coupon, which means if you live in Virginia, that would be state and federal tax-free. Callable in 2031. So if they call it then, you have to pay a premium for this bond. Your return is going to be 3.4% tax-free. But that's 6.4% taxable equivalent if you are in the max bracket. And if it goes all the way to the 2040 maturity, 15 years, it's almost a 7% taxable equivalent if you're in the max bracket. I'll give you one more. Virginia College Building Authority, which is AA1/AA plus rated, so high quality, 5% coupon. The yield to worst, meaning if they call it in 2034, if you're in the max bracket, taxable equivalent of 7.6%. Goes all the way to the 2054 maturity. What's that, 19 years? 8.6% taxable equivalent. So I don't know what stocks are going to do over the next 15, 20 years. The average going back to 1925 is 10.3%, okay? But if you could get the equivalent, after-tax equivalent of 7 or 8% on double AAA rated paper, seems to me, at the very least, these yields are competitive with stocks in a way that they haven't been in a long, long time. So again, there are a lot of other things to consider. I'm not telling you to go out and buy these bonds, nor am I telling you to go out and buy municipal bonds, right? There's a lot of work that has to go into that. It's based on your tax bracket. You have to consult with your CPA to see if municipal bonds make sense for you. I'm not going to get into that discussion. I'm just making the point that I think bonds deserve a bigger look than maybe they've gotten from a lot of people in the last 5 years. And that's even more appropriate now with what the Fed's doing and with valuations in the stock market trading darn near all-time high levels. Hope that was helpful, folks. I'm sure next time I'll have much more to say on the individual stock front. Stay healthy. Until next time, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.